Okay. Basis. What do we know about basis?
It's important.
Second book.
Oh, yeah.
Second tab.
Is it?
Counting adjustment.
This is 1367.
Yeah. Is that the first one of the second book, Tatum?
Second tab of the second book.
Yeah, Q-Step was in the second too.
Oh, okay. All right.
Are we talking about 1367?
1367, yeah. So, okay. Basis 7203.
Like everything with basis?
Sure, let's see what you know.
I don't want to write.
Okay, tell me what to write.
Well, do you like want to know how it, like what increases it, what decreases it, all of that? Oh wow. Okay, we're going deep. Okay, so you have your contributions.
Contribution.
You have income.
Okay, is that contribution would be a plus, correct?
Plus, yep. Plus income. Then you have your other increases and decreases.
What the hell does that mean? Hold on. I'm the dumbass in the room. Let's see if somebody else knows what that means. Kaylee, what does that mean?
I mean, there is a line on the K1 that's like other increases and decreases.
Is that what you're talking about?
Yeah.
And what's embedded in the other increases and decreases? Because now I think I understand what you were saying by that. I think, but I want to see if I'm right.
I mean, depending on who's prepping it, there could be various things. Like there could be your 734 fee stuff in there. Some people put tax exempt income into your other, some people don't.
Okay. So 734 is a partnership context, but I'm good with it. I mean, it's still the same. I mean, both are going to be adjusted for whatever activity is generated by that entity. So 734 and 743 are both a partnership context. So I don't have a problem with that because that is in the general universe of basis, but we're going to be more refined and talk about S corp basis. So you're saying tax exempt income,
Yeah.
okay, plus tax exempt income. What else?
Then you take out your deductions,
What are my deductions?
like your box 13.
My box 13. You're treating me. I used to know every.
Full one in my head.
Okay. So
So like bank charges. Do you really want me to go through all the examples?
what about like 179? What about 1231 losses? Charitables. Okay. Meals, business meals, and entertainment.
Yeah, so you're non-deductible.
Your non-deductibles. I mean, there's all these items that are going to increase and decrease basis. And then distributions.
And then liabilities.
Now you're back in the partnership.
Sorry, I'm such a partner.
Yeah, I mean, 100%. You're that's appropriate for a partnership. Oh my God, how did I miss that? Oh, it's in here somewhere. Okay, nothing. It's in here somewhere.
Loans to the
Sure.
What?
loans to the company, doesn't that go into debt basis?
Guaranteed payments?
Hold on. Did you just shush Nicola?
No.
What did you say?
I said loans to that corporation,
Okay.
loans from shareholders, I guess.
Okay.
What's that increase it?
Yeah.
Yeah, sorry. I was using that as a hash versus a. And you said guarantee, Nicola?
Yeah, and then he said that's partnership, so.
Okay. Guarantee doesn't apply? Is that what you're saying?
No, I'm saying it does, but
And he said it doesn't?
no, well, at a partnership, it doesn't.
Are you going to help him out, Trent?
Guaranteed payments are just partnerships, right?
Guaranteed payments.
Yeah.
You talking about guaranteed payments, Nicola?
I think that's what I said.
Guaranteed payments? I missed the payment
Guaranteed loan.
because I heard guarantee and I thought guaranteed loans.
That is guaranteed loan.
You said payments.
said
You said
payments.
payments.
I said payments.
Okay, so what about does a loan guarantee count as basis?
I think so. Isn't it only loans to the corporation that
Do
count?
what?
Isn't it only like shareholder loans to the corporation that count? For
Okay,
basis?
only that's right, Jack. Only loans from the shareholder. If you guarantee the loan, that does not count for basis. All right. So, stupid question. If I have 0 basis and I have a K1 that says ordinary income equals 10,000. And I have 1231 loss of 10,000. And I have distribution of 10,000. Does anybody know on any level how to diagnose, is my favorite word, what the hell happens to the shareholder? Jameson?
I don't know the ordering rules, but I know there's ordering rules to determine what goes first.
There are ordering rules. Does anybody know the ordering rules at all? Because we just we just went through a population of items, right? And fundamentally, I agreed with the population of items that you guys brought up. But Jameson's right. There's an ordering rule. And I have a K1 that has an ordinary income item, an ordinary loss item, and a distribution. And how you account for that is determined by ordering. Let's see. Such I what's this say? Let's go here. 7. Ordering rules for taxable years beginning on or after August 18th, 1998. Okay? Lucas, what's 1 say?
Income is, or says any increase in basis attributable to the income items described in section 1367A, 1A and V, and the excess of the deductions for depletion described in section 1367A, 1C.
Okay. So depletion is something that you could not build a device that measures my indifference to depletion. I don't understand it. Doesn't affect my world very often, and when I see it, whoops, I missed it. Sorry. I'm not saying that that's something that you should prescribe to, but when I hear the word depletion, I don't even know what it really means. I don't know how to interact with it. So we're just going to admit where we have our failure. That's a failure of mine. I just own it and I move on. I don't even know what the hell it means. So, but any increase in basis attributable to income items described in 1367A, 1 and B. So let's figure out what that says. And that drives me nuts. It used to drive me nuts. Is why can't you just use frickin' words to tell me what the hell you're talking about? Why do you have to point me to another section? Well, I've gotten over that. So what's A say?
Still me?
Yeah.
All The items of income described in subparagraph A of section 1366A1. B, any, or wait, did you want me to start at 1 at the top or?
No, you're okay.
Okay. B, any non-separately computed income determined under subparagraph B of section 1366A1, and C, the excess of the deductions for depletion over the basis of the property subject to depletion.
Okay, so I'm going to give you the rule of thumb, income. And you saw that on the other page. What that's saying is you have to take all items of income on the K1 and you increase basis first by that. So if we use that rule, my basis starts at 0. So what's my ordering rule tell me I have to do? So I have income first. And it's going to be all items of income, I think. Pretty sure that's right. It's 10,000. So what's the next piece of the ordering?
Distribution.
Distribution. Any decrease attributable to distribution. How much do we have for distribution?
10.
10,000. Then what?
Is the rest of loss carryover?
What's next?
Non-deductible.
You know what? Let me revise my facts because actually that's kind of important. Non-deductible expenses, 2,000. Because that is really important. I should have been smart enough to get ahead of that one. So my beginning basis, Jack, was what?
0.
It increased to what?
Increase to 10,000 with the income.
And then decreased to what?
Back to 0 with distribution.
Back to 0 with distribution. So right now, I have a beginning basis number. I've accounted for my income items. And if I had capital gain on here, that would also be an income item, so on and so forth. It's going to be increased by income first. Then it's going to be decreased by distribution. And now it says what, Jack?
Non-deductibles.
Non-deductibles. How much do I have in non-deductibles?
2,000.
2,000.
Okay.
But I'm out of basis. There is, unless you're an idiot, okay, and we're going to talk about this, and I say this with sincerity, you can't drive basis negative with non-deductibles. So we're going to get to year 2 before we talk about what we have, or the rest of this. This non-deductible disappears. It never affects basis. Because to Jack's point, I started at 0, basis went up by 10, down by 10, I'm at 0 basis. I can't drive basis negative by virtue of a non-deductible expense. I can't do it. So now that non-deductible expense, which is ordinarily a hit to basis, and if I change the facts to say my beginning basis was 2,000, at that point, if this was 2K, I'd have non-deductible enough to have that non-deductible affected and drive it to 0. But that wasn't my fact pattern. Yeah.
Isn't there a carryover section on the 7203?
That's what I was thinking.
There's carryover section for what?
For items that if you have 0 basis, you can carry it over for when you do have basis.
I think on a partnership, see, you had me at, this is funny, you had me at a disadvantage. Because do you know how hard I've grinded on a 7203? 0. My give a shit level about a 7203 should be better. I should give a shit, but I don't. Now, the fact I don't give a shit gives you absolutely 0 right to act like I do. You need to give a shit. That's real. See, what were we saying about me being me and not following rules? The 7203 is probably going to fall into that category. It's important. The fact I don't interact with it like it's important doesn't mean it's not. I'm being 100% sincere. I'm old, I'm tired, and I want to retire. So if I don't have to learn the 7203 and all the nuances before I retire, I'm okay with that. You, on the other hand, what are you, 18? How old are you?
22.
Let's pretend that you're going to trail out and retire at 62. Whatever. Fine. How many years do you have to travel to get there? 30. That's a long fucking time. Okay? So the fact that I don't care about the 7203 when I got somewhere between 5 years left, I'm hoping it doesn't get me in trouble. You guys, on the other hand, really do need to give a shit and understand what that means and why it exists. Yeah.
They make you want to retire sooner? Because yesterday was 5 to 7 years.
It fluctuates.
Okay.
The answer
Day by
is no.
day basis.
It's a day-by-day thing for sure.
Per share, per.
Like my joke. He just said it louder.
Play with your chest.
So, but for I think, in a partnership context, that $2,000 because of debt basis causes a reduction in debt in basis. But in an S corp context, if you bump into zero basis, that non-deductible disappears. It goes away, and you don't want to carry it over. Because if I had 2,000 beginning basis, that 2,000 beginning basis would have disappeared by virtue of that non-deductible, which increases my gain when I go to sell it in the future. So I'm more interested in seeing that non-deductible disappear than carrying it forward. And this gets into the idiot territory.
But then, like your other deductions, you carry forward.
What's the other deductions?
Your box 13.
That might as well be in Farsi, Sam.
Sorry.
But you're talking about my 1231 loss? Because box 13, you're saying the loss, right? I think.
Well, I mean, like even just like deductions that you can't take, like expenses that like, say there were expenses on there too, on your K1.
What expenses exactly?
Like
I'm being
Bank
specific.
charges.
like portfolio deductions is what she's talking
Well,
In box 13.
portfolio deductions, if they're 212 in nature, which it's possible it's on an S corp, you're generally going to see that more in a partnership than an S corp. But an S corp could have a partnership where those are flowing through. Those are still non-deductible in nature, aren't they? A bank charge, unless it's a business expense, which that business expense, a bank charge would be embedded in line 1
Yeah.
as an ordinary and necessary.
Yeah.
So non-deductible is going to be meals, entertainment, which bank charges, legal fees, things that fall into 212 might hit a box 13, but those are non-deductible in nature, I think, if you and I are on the same page, and I'm not entirely sure that we are, Sam. Not 100%
okay.
sure that we are, but if it's non-deductible in nature, that's a bucket of expenses that could harm basis, but if you're at zero, then it won't harm basis and it'll just disappear.
The things that are in like box 13 are the ones that are on your Schedule K that aren't on page 1.
That so doesn't help me.
You're talking about a partnership K1 though.
Well, even on an S corp K1.
Is
'Cause-
there? I don't know which one.
I don't know what it is on an S corp, but
That's why I'm saying I don't know.
I don't know. I honestly don't know. And I'm not trying to be glib or
yeah.
I genuinely don't know. So if I don't know, what's my
No,
there's
that's
two
fair.
answers. There's two answers
Why
in
don't
the
we
world.
just look it up?
Do what?
Box
You can
11.
just look at
In the carryover section, there is a thing that says other deductions.
That get carried to the future. Well, if that's being populated and it's non-deductibles, then it's wrong.
Well, I don't know if that's what it is, but it's some other deduction.
See, this is, and I say this with sincerity, with genuine sincerity. Part of the reason that I know some of the things that I know, you can separate in buckets. One is I had an undergrad that had an accounting degree. I had a graduate degree, which was tax. And operating with a graduate degree that was tax, I had information in my head, but that information in my head was not yet executable because I didn't have the experience to really understand what was in my head. And it was through experience that made the stuff in my head now executable. But that level, that now executable information needed to be built on. And what I mean by that is, if I were young and sitting in your seat and some old guy like me said, I don't know what a 7203 is, and nor do I give a shit, but you should. And I say that with sincerity. And now there's this mystery we're confronting of what this other deduction is on the 7203. I don't know what it is, I don't know what it means, and I don't know how to interact with it. Lane has 30 years left, and so does everybody else at minimum, God willing. So it's up to you to be intellectually curious to say, what exactly is in that bucket? Why is it there? How do I interact with it? If it's non-deductibles, if it's tracking non-deductibles and it's harming basis on a go-forward basis, that's a flaw in the system. And I, as the person that was intellectually curious, looked that up, verified that that was a flaw, and went to whoever the powers to be in the company and said, that's a flaw. We're doing our client a disservice. Pete was not smart enough to figure that out because he's not smart or he doesn't give a shit. One of the two, or a combination thereof. So this bucket, there's a real benefit to saying that you're intellectually curious and figuring out what that is. Because part of what my process over the years has been is, I don't understand it. So if I don't understand it, I'm going to take an absolute hammer to it, break it apart, identify all the pieces, like what I said. There's lots of pieces over here. Well, let's go back to what we said over here earlier. X sold Z. And I developed 3 or 4 or 5 thought processes to go, what is it? So I could diagnose what that is. That, over time, has been me taking a hammer to, I got a legal document that says X sold Z stock. I now have to break that apart into 1 trillion pieces and then put it back together and make a determination of what the tax consequence that is. That wasn't nobody gave me that. I'm sure they did over time, right? Don't get me wrong. I don't want to say, well, look at me, I got it all by myself. That's not what I'm saying. But there is a level of intellectual curiosity and desire to know something that said, you have to take this apart and put it back together. This is not a guided tour because you got to do it on your own. That's the only way, me personally, I learn. Stacy Watson, her brain is what I call her brain RAM, random access memory. She can read and digest something. She executes on whatever that is. She understands it. And then her RAM turns into a toilet. It goes, psh, there goes the information, it's gone. She doesn't retain it. Not the way I do. Mine is ROM, read only. Because what I have to do is I have to break it apart and put it back together over and over and over again until I get it. And once I get it, I got it. There's no toilet. It's there. So on the 7203 in this mystery carry forward, whatever it is, if I were in your shoes, I'd take that apart and put it back together and say, why is it there? What does it mean? And is there a mistake? And if there's a mistake, let's fix it. Because I can tell you, the rule that I have in my head is, and I think I'm right, and there have been times where I think I'm right, and the rule has changed. That's possible what's going on here. Don't think it is. But I can tell you, non-deductibles, when I have zero basis, disappear. I know that. Because either rules changed or the election I'm going to talk about in a couple minutes has been legislated out. One of the two. And it's possible it's been legislated out, but I doubt it. Okay, so then We have non-deductibles, which now we're going to say 0 because of, well, that's interesting. That's an accomplishment, isn't it? The non-deductibles, is there a trash can in here somewhere? That's going to piss me off because I'm going to pick it up again. Here, that's yours now. Okay, so your non-deductibles are 0 by virtue of the limitation because there's no basis. Okay, so now we've accounted for non-deductible. What else has not been accounted for?
The loss.
The loss. And when we get confronted by a loss, what's our procedure? How do we diagnose whether we can take a loss or not?
You have it.
What was it? What, Lane?
You have any income?
Do you have any income?
The hurdles?
The hurdles. And what are the hurdles, Jack?
Oh, so I didn't want to answer.
You said the right word. What are the hurdles?
Basis,
Basis,
passive or active.
at-risk basis,
Oh yeah. Then passive
passive or
aspect.
active, and excess business. So now we have this schedule, and now we have the ability to run our hurdles, our loss hurdle. So we have a loss. Do I have basis to take the loss? I don't. I trip at the first hurdle. So if I trip at the first hurdle, I can't take that loss. And if I can't take that loss, what happens to that loss? Does it disappear? What happens to it?
Carries
It
over.
carries over. What form does it carry over on?
Start with an 8.
Start with a 6.
Starts with 6. I feel like I'm on Price is Right with like a little
6823.
6823.
62,
No.
64.
61,
61.
61, 26.
Nope.
83.
Nope.
32.
There's only like 100 numbers in here.
61.
98.
Yeah, that was my next one.
Oh, yeah. You actually sounded pretty sincere there, Trent. Oh, yeah, that's the next one I was going to trip on.
It was
What's the passive form? Isn't that sort of
8552.
but the lot or the carryover song? One?
What was that, Jameson? Sorry.
Nothing.
Now I'm curious. What the fuck did you say?
The passive form starts with an 8, but the carryover is on a different form.
For basis limitation is 6198. For passive, it's 8552.
What?
Okay, so now I have a limited loss of 10,000 reported on form 6198. Okay, so let's change the facts just for a second, because this is the ordering: income, distribution, non-deductibles, loss. Yeah.
Fair question. So like that loss then, so like next year, if they have basis, is it the first thing that gets taken out, or is it still follow the same, like distributions, non-deductibles, and then loss?
That's a great question, Jimmy.
Gift card.
I'm getting limited on the fucking gift cards over here, because that's the next level question to me. It's coming your way.
We're here to become experts.
Do what?
So we're here to become experts.
So Jimmy wants to know, and this is an awesome question. Where the fuck is there? There it is.
Say it to the mic, Pete. What was that?
What I'd say in the mic is 1 out of 100 isn't bad. That's what I'd say in the mic, Nicola. Okay, so So this is year 2. K1. And my ending basis was what? It's 0. Beginning basis is 0. What's my ordering? Income? How much is my income, Lane? 10,000. What comes next? Distributions. What comes next? Oh,
8,000.
oh, 8,000. Yep, sorry. Thank you. Because I did that on purpose. What comes next? Non-deductibles. Is there any loss on the K1 in year 2? But I saw the carryover loss on the 6198. So the ordering says, yeah, you had income, but you also had distribution, and you also had non-deductibles. So you could not blow through those barriers to get to that loss. So at the end of the day, if these two didn't exist, all you had was 10,000 income, basis goes up by 10, the 10,000 kicks in, so basis goes up by 10, but you also have this carryover loss of 10 that now is released from 6198, which brings you back to 0. So let's change the facts a little bit. Okay. My beginning basis is 10. Instead of ordinary income, let's see, I have income of 0. I have, oh no, hold on, excuse me. I have an ordinary loss of 10,000. I have no distribution, and I have non-deductibles of 10,000. Okay, so my beginning basis is 10,000. My K1 is an ordinary loss of 10,000, and my non-deductibles are 10. So what is my ordering rules that we just went over say to do? What goes first?
Income.
Do what?
Income.
How much income do we have? 0. How much distribution do we have? 0. How many non-deductibles do we have? 10. So now my ending basis is 0. How much of that ordinary loss do I get to take because of my loss hurdles?
0.
0, because I'm out of basis. Well, that sucks, right? I don't want that to happen. So under
Don't you just carry it forward?
do what?
Don't you just carry forward the loss then?
Okay, well, this is something that I didn't know I was going to talk about yet, but I'm going to push this aside. We're going to stick with my election. So that when I saw basis selection, I expected something else to be there, and it wasn't. That's a surprise. So there's an election. That you can reverse the order of non-deductible and loss. So under the normal rule, non-deductible goes first, correct? But this election says that I can reverse that. And I got beginning basis of 10,000. and it says incomes first, and it has distribution next, and it has loss next, and it has non-deductibles last. It reverses it. That's what the election does. Ordinary, beginning, income, distribution, non-deductible, loss. The election says, no, I'm going to elect to reverse those two. Beginning, income, distribution, loss versus non-deductible, non-deductible being last. So if this is my fact pattern, and I have 10,000 at beginning basis, and I have 0 income, 0 distribution, well, my gosh, I get to take that loss. Yeah.
Why would you want that? Because doesn't the non-deductible disappear and then the loss would carry forward?
Well, under our normal rules, if I get to 0 basis, the non-deductible disappears, right? Okay? So using that same logic, if I get to 0 basis and we never account for the non-deductible, under the basic rule that we talked about, the non-deductible would disappear. Right?
Yeah.
Wrong. Okay, so under this scenario, is it better to take the loss this year, or is it better to carry it forward?
Take it.
It's better to take the loss. So by virtue of making this election to reverse the loss and non-deductible, I've freed up this loss, and now I get a tax benefit. But over here, or earlier when we had that $2,000 number on the K1, that $2,000 loss, by virtue of the distribution and otherwise, that disappeared because it never hit a basis, because my basis is at 0, and I can't go negative. Over here, if that's true, the non-deductible would disappear. The IRS says, hey, if you're going to, we'll allow you to play that game. We'll allow you to reverse the order and take the loss first and put non-deductible at the end. But in exchange for that, the amount of non-deductible doesn't disappear. It's carried forward. So next year, when I earn $10,000 and nothing else happens, that non-deductible from the prior year depletes future basis. The 2,000 that we talked about earlier did not. It just disappeared.
So it's only when you make the election.
Correct. And that might be what's in that 7203 box that is pertaining to this election. Maybe. Again, if you're intellectually curious, go find out.
Question. Yeah. When there's a carry forward, where does that go in the ordering? Like just at the very end, or?
I'm gonna assume. I don't know that.
Or is it just whatever the carry forward is, it would go in that bucket?
Say that again.
Like if the carry forward is a loss, it would go when the losses go.
He's talking specifically about the non-deductible, though.
Well, or the regular one, just.
So I mean, the carry forward, the 10,000 loss carry forward from that's on the 6198.
Yeah.
Waits for income to be generated to release that loss. So if let's do it two ways. I have a 1231 loss that got limited. Okay, that's scenario one. 10,000 income in the future year makes that the character of what was captured by the basis limitation retains that character. So when 10,000 income occurs in the future, the release of that at-risk basis limitation is 1231. It was capital loss, 10,000 shows up, the release is going to be capital in nature. If it's ordinary loss, the release is going to be ordinary loss. So whatever this loss is that got captured due to my basis limitation is going to retain its character when it's released. I don't know if that answered the question or not.
Kind of what I was getting at was, so what we've been going, got income, okay, and then distributions count against the increase. So like in that ordering, like say year 2, like okay, year 1 we've got the loss carry forward. Year 2 we start the whole process, the whole ordering process over again. I was just wondering like where that carry forward slides in.
So under the normal rules, if I have a 6198 carry forward, That's what we're talking about, I think. Right, Lucas? Of 10,000?
Sure.
If this is my fact pattern, I get 10,000 in income. Do I have income? Yes or no?
No,
Do I have distribution? Yes or no?
no.
I have 10,000 non-deductible, and my basis is depleted down to zero.
Hmm.
This carryover, we never get to it because it remains released in this loss category.
Okay, so it stays in the same
It
category.
does.
What if there's a loss also in year 2, which takes priority then? The carry forward or the current year loss?
Well, under this fact pattern, this just would go up to 20,000 if I had lost in the year because I don't get there.
What if you got
Pretend you
it?
did.
What if you had 10,000 of income that year
If I have 10,000 of income,
and you
and
had
then, and I have
another?
and instead of non-deductible, I have 10,000 of loss. It'd be that one. that
Can
takes
you use
priority.
a different amount?
Sure. How about 5,000?
50.
5,000.
But so then is that loss that you're taking, is that the current,
Yes.
not the carry forward?
And then I'd have 5,000 left over, which I could now use against the 10,000 carry forward.
Okay.
So you always have to dip into current before the carry forward.
I don't know that with certainty,
I
but
guess
that,
always is probably dangerous.
no, I don't know. But I've never been asked that question that I can recall. But in my head, I've always had the rule that I've got to run through my ordering before I get to the carryover. That's what has made sense to me. Have I ever read that? No. Can I see a logic tree that would say that's a bad idea? No. But again,
I mean, that's always been my thinking too, is that carry forwards are last.
that's my instinct. I've never read it, and I don't know how else you would do it.
Does it carry forward indefinitely?
It does. Well, until you die, right? I mean, death affects carry forwards.
Okay.
This might be a dumb question, but what's the point of taking the election if the non-deductible is just going to be carried forward?
That's a great question. Because how many times in my career have I actually made the selection to have non-deductibles go first?
Never?
Nope.
Oh,
It's
you
more than
actually
never.
have?
I have.
I thought you said non-deductibles don't carry forward.
If you make
If you- Oh, okay.
If you make the election. The time that I make the election is the company I'm dealing with is terminal. We're trending towards we're no longer going to be here. And it's generating losses. I want to maximize my ability to take the loss. So I make the election, turn off or reverse those so I can maximize the loss I'm able to take this year. And if it dies next year, who cares? So it's only in a terminal spiral, in my view, that you're going to make this election. Otherwise, it doesn't make sense. Yeah.
Can you, if you sell your investment in the S corp, is it like passive losses where you can take the losses when you dispose of the activity?
If it's passive. But that's different than 6198.
That's what I'm asking. Like, if you have losses hung up due to basis, can you take them when you dispose of the activity?
Okay. Maybe. Depends on how aggressive you are.
Okay.
So we agree that there's an ordering to this basis. Correct? And now we have this 6198 loss that exists. Ready for this? 1.465-66. I think that's right. So what we have what are our basis hurdles? Okay, so seriously, I mean this is truly important for this analysis. What's the first hurdle?
Basis.
Basis. Second,
At risk
at
basis.
risk. Third,
Passive or active?
passive versus, well, just passive. And then
Excess business loss.
excess business loss. Oops. We had non-deductible at 10. 0, and we have 0 ending basis. We have the loss hung up on the 6198. So what 465 is at-risk rules. That's what 465 is. And if we say 1.465, what am I referring to?
Reg.
The reg. So these are the regulations that support the code section of 465. And what this says, what 1.465 says, is you're saying that you have A who owns X, and A has a $10,000 at-risk carryover on 6198, correct?
Mm-hmm.
We have 0 basis. A sells shares for 20,000. Proceeds 20. Basis, how much is my basis?
0.
0. So what's my gain? Gain is 20. And now you're asking, well, if that's true, what happens to this basis? So under 1.465-66, it says the gain from stock sale, and more importantly, Sam, and partnership interest increases at risk basis. So my at risk basis starts at 0. I have $20,000 of gain. So my at risk basis increases to 20. What are my hurdles?
Basis, at-risk basis, passive, excess loss, excess basis
Okay.
loss.
So this is how stupid this is to me. And I have taken a contrary position to the IRS on this. And I'd lose 0 sleep over this. What the IRS says is, what's the top link up? What's my top bookmark up there?
1367.
1367. And what's 1367 address?
Basis.
Basis. Right? So now, 1367 is right here for S Corps. And for partnership, 723?
Yeah.
I was chambers.
I think it's 723. I don't know. I'm struggling. That feels right, but I give that a coin flip. So what 1367 in an S corp context says, and what 723 says in a partnership context, is when you have an item of income or an item of loss or an item of distribution or item of non-deductible, it affects your basis. So there's 2 court cases. One's a partnership court case and one's an S corp court case. And they split. The partnership S corp says the 20 makes your basis. Let's do it this way. Partnership S corp. Beginning basis, beginning basis. Both happen to be 0. Okay? The partnership court case says this gain from the sale, and this is under this reg, 1.465, where it's at. This is under this reg, 1.465-66, says you get to increase basis for the sale. So now my basis is 20. And the court case says you get to hop over that first hurdle because you got basis. And then you get to the second hurdle. Well, I got 20. Now I get to hop over the hurdle again. Now I'm at passive. And now that's its own thing. If it's full disposition of the asset, we get to take the loss no matter what. What the S Corp case says, well, under 1367, there is no item of income that's being produced by the entity. And since there's no item of income being produced by the entity, even though the reg says, and it acknowledges, the reg says you have at-risk basis. But the ordering of the hurdles are basis, at-risk, passive, and excess business loss. So the court case, in my view, wrongly decided that 1367 says you don't get basis for the S Corp stock. Therefore, you trip over that hurdle. Therefore, you don't get the loss. But you have at risk. Sorry, you didn't get there. So in this case, I've taken the position, screw you, IRS. This court case, because the reg section, the fundamental nature of the decision on the S Corp is it does not give you basis under 1367. Therefore, you don't get over the hurdle. The partnership case says you get basis under 723. Therefore, you get over the hurdle. The gain was not generated by the partnership, nor was it generated by the S Corp. So on my split decision from the IRS, I'm going with the partnership case and applying it to both. Come get me. So if that's true, I got 20 of at risk, or 20 basis, 20 at risk. My at risk carryover is 10,000. I'm releasing that 10,000. So I'm going to have 20,000 of income and a $10,000 loss. And there's a folder under Behringer, Ciasso, Donnell that has this research.
What would the case be if you didn't sell it, like they just went out of business, so there's no proceeds on it? Can you not take that?
Well, how are you? Let's dive into that. How are you going to have a at risk? How are you going to have a $10,000 loss if there's no proceeds? This carryover. And let me put a finer point on this, and maybe Sam can help you. How am I going to have a negative capital count of 10,000? How do I get a negative capital? Debt-funded losses. So in both cases, I have a debt-funded loss. So now I have an S Corp that has a debt-funded loss of $10,000. Since I have a debt-funded loss of $10,000, am I going to be able to pay that back? I owe somebody 10 grand. Am I going to be able to pay that back? No. So this is funny. This is actually interesting that we actually took this turn. If we can't pay the $10,000 and somebody forgives it, that's cancellation of income, cancellation of debt income. And going back to under there's section 108 that says cancellation of debt income is either going to be taxable or it's going to be tax deferred. Boy, that seems to be a theme, doesn't it? And 108 says if you declare bankruptcy and the debt's forgiven, cancellation of debt income is tax exempt. If, not for Sam though, in partnerships, be careful. Partnership can declare bankruptcy and it can still be income to the partners. And we're not going to go into COD income,
That's fine.
but partnership sucks, corp's okay. So the S Corp, in this example, we got 10,000. They have an AP to Lutz. They're just gonna. I don't have the money. I can't pay you. We aren't gonna take them to court. It's not gonna go through bankruptcy. So we just go forget it. We forgive it. That's cancellation of debt income. And when we talked about 337, what was one of the standards we talked about? In order for it to be tax deferred. What are the elements that had to be present for it to be tax deferred?
Solvency,
Solvency is one of them.
80%.
80% parent sub insolvency. Solvency is another measurement that occurs within this context. So now, the fair value of my assets, Trent, are how much?
0.
What's my debt?
So like 10,000?
10,000, because that's my debt funded loss. I'm insolvent to the extent of 10,000. How much debt is being forgiven by Lutz? 10,000. So now, to the extent my insolvency, the debt forgiven is going to be tax exempt. There's a court case, boy, this is a real fun for me, called Gitlitz. And when the corporation declared bankruptcy and it was insolvent and had $10,000 of tax exempt income, one of the things that we had on our list for basis increases was tax exempt income. Well, the corporation had income and it was tax exempt, and this guy Gitlitz said, you know what? My basis went from 0 to 10,000, and now I'm able to take a capital loss. And the IRS said, no, you can't do that. You never put money into this. And Gitlitz won. So he was able to take this $10,000 cap loss on this tax exempt income that was generated by the insolvency and 108 cancellation of debt income. That pissed off the government off enough. They said, no, COD income, tax exempt COD income is not a basis increased. It is a carve out. You don't get to increase basis. But nonetheless, you have, under the 108 rules, it says that when you have a COD event and it's tax exempt, we're not going to make you pay tax on that, but we're going to make a trade with you. And that trade is, we're going to make you reduce NOLs, basis and assets, and other items. So in this context, we have an S Corp with $10,000 worth of payables to Lutz. The $10,000 payable to Lutz is forgiven. Now there's $10,000 of COD income, which is tax exempt but does not increase basis. But now there's this exchange that occurs. There's no NOL, there's no assets on the balance sheet, but you have this at-risk carryover. To the extent that you have COD income that's tax exempt and forgiven, it reduces your at-risk carryover. And the math always should be right. It should just go to 0. That was a hell of a question.
Sorry about that.
No, there's a lot there. And always that adjustment on COD occurs in the year subsequent to the year of bankruptcy. COD would be an interesting thing for us to cover, but that was more than I ever intended to talk about.
What does COD stand for?
Cancellation of debt income.
Okay, thanks.
Okay, I'm sure my logic's going to fall out here somehow on why this is my next slide. I don't know why this is here, but we're going to go with it. I genuinely don't know why this is here. I'm hoping it's going to become clear.
Have you ever thought about making yourself presenter slides?
No. That requires too much thought.
That's fair.
Because, again, what you've seen me do is sooner or later I catch up to whatever's in my slides.
Yeah.
And that's an error on my part, and sorry.
That's okay.
No, because it's kind of bad because your ability to take notes is affected and some other things. I get it. It'd be nice to go, oh, it'd be nice if we were on that page when you talked about it.
Yeah, it's nice because then we can like skip forward past.
Do what?
If you already talked about it, also it feels like we can like go past a lot of pages when we.
Does
get
that feel
to it.
good,
Yeah.
Emma?
Yeah.
See, you're the downside of, well, I wish I had the page. And Emma's like, fuck yeah, I get to skip some pages. Why am I talking about this? Well, let me get my bearings. Because I really don't know why I'm talking about this.
Don't.
Don't. What you just said, Jack?
That was Jimmy.
No, it
You
wasn't.
keep mixing up us.
Mike,
Jimmy. Thank you.
Mike picked it up.
It's always Jimmy.
Okay, these pages, if you're intellectually curious, have to do with basis ordering rules that we talked about, putting non-deductibles ahead of losses. And if you work through the fact pattern and the basis schedule, you'll see how that election diminishes basis and you'll have a greater gain on the end, and it's a really stupid idea unless the entity's terminal. That's the only time that you're ever going to make that election. That's what those pages are really about. The idiot election. I don't know. You'd have to be an idiot to make it.
But you've made it.
Do what? Only on terminal. That's non-idiot.
What did you? Sorry, go ahead.
Is the election like once you make it, you're stuck that way?
Yes. Well, that'd be very convenient if that weren't the case.
Weird stuff sometimes.
I mean, once made, always made with respect to that, and you probably can go to the secretary of the IRS and ask to get out of it. But I've never asked that question, but I suspect the answer would be no. That's what I suspect it would be.
Unless you blame it on the attorneys.
You don't get to blame that one on the attorney.
I have a question.
Yeah.
And maybe this is something we table so that we can get through the rest. But what is your process for deciding that a business is terminal?
Well, the Supreme Court decided an opinion that you can look at porn and know what it is, but you can't define it. A business going out of a company going out of business, you look at it going, they're in trouble.
Like it's like obvious to you when you should do this?
Well, I would say that obvious is too strong.
Okay.
But I mean, there are businesses that have pulled themselves out. I thought,
Really?
yeah, that they're in trouble. They're not going to make it. So my ability to discern that is not 100%. But you look at it and say their cash flow is X, their debt is Y, people are nipping at their heels. This is not going to work out well for them.
How many years out do you usually like decide that? Like, how far is too far away to be like, oh, this is a terminal?
If I would never make that choice unless I thought they were going to be out of the business within the next year.
Next year.
I wouldn't make that choice.
Okay.
Because at the end, again, I think it's catastrophically stupid in these pages that we're flagging are the detriment to the basis and of the company. And I did this math, I think, years ago. Let's do it, because I'm now curious. If you have 10,000 of cash, 10 of equity, let's say 10 of debt. Of debt, not equity. And the company, no, let's make it 15. 15 and 5. Again, I did this math years ago, and now I'm going down a rabbit hole I don't know that I want to go down, but if I have, let's say, beginning base is 5,000, and I have 10,000 of non-deductible, that means that my basis goes to 0, my cash went from 15 to 5, my equity in here goes to -5, correct? And I'm in balance, right? 10K, 5, and 5. I'm in balance, right? But this non-deductible, it's 50%. That was, let's see, 50% of the non-deductible. That'd have been 5 because it's 50%. That gets me to 0. The punchline, and I'd have to prove it. I'm struggling. I thought I could do it quickly. The punchline, what I think that proved earlier, is the non-deductibles that don't affect basis over time, and where I've seen this dramatically is with medical staffing companies. Because medical staffing companies have a lot of meals and entertainment through per diem that hit their tax return as 50% not deductible. And since it hits their return to 50% not deductible and we run into business limitation, that non-deductible disappears. And when I go to liquidate the company, since that was not a hit to basis, during the full time, on backside it either creates a loss or minimizes the gain by virtue of that non-deductible not hitting my basis schedule. I can prove it out again, but I was pretty surprised by that when I did it 15 years ago. So the fact that non-deductible gets pushed away is a future benefit in terms of the sale of the company. Okay, so we're going to talk about distributions. And screw whatever this is. Because that one page, swear to God, I think it's just out of order. The one that was there before. Nicola?
Calling someone?
Nope. We said an S corp can come in two categories in terms of, well, just two categories. Let's see if you get it. Anybody, because that's a vague as hell question.
ENP, no ENP?
EMP, no EMP. That's good enough for me. Okay. S corp that was converted from C and has EMP. An S corp with no EMP. There's two categories. Okay. 1368. We're in code section 1368. And there's two subsections that we're going to confront. And those subsections are 1368B and 1368C. And 1368B is corporations with no EMP. 1368C is corporations with EMP. So, what if somebody's going to tell me what the basic rule for distributions are, or how to account for the tax result of a distribution, what's the basic rule that we have? This one you should have. Distribution comes out, what happens? You decrease basis, and if it exceeds basis, gain. Okay? That's a general rule that we should be relatively familiar with, I think. Distribution is a tax-free return of basis, is our general rule. And if we exceed our basis, it's deemed to be a sale or exchange of stock, even though we didn't sell our stock. So, with that said, Lane, what's B say?
S corporation having no earning profits. In the case of a distribution described in subsection A by an S corporation which has no accumulated earnings and profits, one amount applied against basis, the distribution shall not be included in gross income to the extent that it does not exceed the adjusted basis of the stock.
So that's our first rule, right? It's a tax-free return of capital. What's the second one?
In excess of basis, if the amount of the distribution exceeds the adjusted basis of the stock, such excess shall be treated as gain in the sale or exchange of property.
Okay.
Okay, that's our second rule. Those are the rules that we know. Okay, so Tatum, what does C say?
Read it all, or
Yeah, it's going to be a mouthful. Sorry.
that's good. Oh,
Oh,
sorry. S corporation having earnings and profits. In the case of a distribution described in subsection A by an S corp which has accumulated earnings and profits. Number 1, accumulated adjustments account. That portion of the distribution which does not exceed the accumulated adjustments account shall be treated in the manner provided by subsection B.
Stop just for a second. So this is what drives me nuts, and I learned to appreciate, is it said subsection B. What does that mean? I'm being serious. I mean, what it's,
Go
the
to
last portion
subsection
says, shall be treated in the manner provided by subsection B.
Yeah, go back to subsection B.
You got to go back to subsection B, and what's subsection B say?
S corp having no earnings or profits.
And what's B1 say?
Amount applied against basis.
Amount applied against basis, and if we exceed basis, what happens?
It's a sale stock.
It's treated as sale or exchange or stock. So let's dissect C1 for a second. Let's go back and talk about C1. What's C1 say again?
Portion of the distribution which does not exceed the AAA shall be treated in the manner provided by subsection B.
Okay, so does anybody know what AAA is? We talked about it. What is it, Trent?
Undistributed S corp earnings.
Undistributed S corp earnings. So, said differently, in Trent's words, to the extent the S corp has had earnings that is not distributed, which is AAA, you refer back to your normal distribution rules under B, which is return to basis and capital gain to the extent it exceeds basis. So once we exceed AAA, or otherwise known as, Trent,
Distributed S corp earnings.
undistributed S corp earnings. Okay, that's what AAA is undistributed S corp earnings. What happens next? What's C2 say?
That portion of the distribution which remains after the application of paragraph 1 shall be treated as a dividend to the extent it does not exceed the accumulating earnings and profits of the S corp.
Okay, so to the extent when we have the corp convert from C status to S status, the C corp has C corp earnings and profits. Okay, to the extent that it had C corp earnings and profits, we blow through our AAA first, which is Trent.
Undistributed S corp earnings.
Undistributed S corp earnings. The next distribution is going to be coming out of CEMP, and if it's coming out of CEMP, Emma, what kind of income do you think that would be if it's coming out of corporate earnings and profits? A dividend. You look confused. Huh? A dividend.
I think he answered his question.
It's a dividend. It's going to the S corp's going to issue a 1099 div, the same way you get a 1099 div on a brokerage statement, the same way you get, you report it as a qualified dividend on your 1040. I'm making a statement, not asking a question.
No, not paying attention.
Okay,
Sorry.
it's going to be a dividend. Did everybody but Emma track with that? Are you up? Are you caught up to us, Emma?
Yeah.
So would it
Okay,
be
good.
passive then?
Do what? It would not be passive, it's portfolio. Okay, then so let's say that we have a distribution that falls in this category where I'll have a total distribution of $10 million or $1 million, and when I converted to from S to C, I have EMP, just for argument's sake, of 800,000. So if we get through C1 that says refer back to B, and Lane, what's B say? Return of distribution is going to be return to basis. To the extent it exceeds basis, is going to be
Sale.
sale or exchange. We've blown through that provision. We got $1 million still unaccounted for in our distribution, and we're going to do this accounting in a little bit, but we got $1 million left. When we converted, we have EMP of 800,000. We still have $1 million left. So what C2 says, if you have $1 million left that's unaccounted for after you get through C1, then you have a dividend to the extent of 800,000. And the corporation has a responsibility to issue a 1099 div of 800,000. So now we have 200,000 left over, in my very high level fictional example. So now what's C say? C3 say?
Any portion of the distribution remaining after the application of paragraph 2 of this subsection shall be treated in the manner provided by subsection B.
Which is where? It's previous page, right?
Yes.
Goes back to normal distribution rules.
Mm-hmm.
So to the extent we have AAA, which is defined as
Distributed S corp earnings.
undistributed S corp earnings, it points you to B, which is return to basis, capital gain. Once you blow through AAA, which is,
Undistributed S corp earnings.
you now have to categorize the amount as dividend to the extent you have CE&P. Once you get your CE&P depleted down to 0, you go to C, which says go where? Back to B, which says what?
The regular, if it exceeds basis, it's a gain.
Return tax-free return to the extent you have basis, and once it exceeds that, it's gain loss. Okay? Yeah.
If you have that dividend scenario, does that decrease your basis?
No, it does not. Absolutely not. And that's going to get demonstrated in this. Okay? Okay, so let's go back to the page that seemed to be a mystery. Let's see, what page are we on? 16? Was it before this? When are AAA and basis different? Do what?
So let's go with lower.
Yeah.
Oh,
I have no idea how that got inserted in that spot, and I'm sure it's my fault. Because the ordering did not make sense. Okay, so Trent, what is it? What's AAA?
Undistributed S corp earnings.
Undistributed S corp earnings. AAA basis. So your starting point, the thing that you really need to understand about this concept of AAA and basis, what is it?
Undistributed S corp earnings.
Undistributed S corp earnings, which is ordinary income on line 1 of a K1 income. Yes. Does that affect basis? Yes. Every line on that K1 affects basis, does it not? So K1 items affect basis, either a plus or a minus, one of the two. AAA, what's the definition?
Distributed S corp earnings.
Undistributed. So K, Schedule K, plus or minus. K1, K. I'm saying that with intention. AAA is an entity level measurement. K1 is a shareholder level measurement. What is the fundamental difference between K and K1? What's the only difference possible?
the entity versus the shareholder.
Well,
Like
the-
the Schedule K is gonna be 100% and the K1 is gonna be the partner share.
Correct, shareholder share.
Sorry. I'm sorry.
No. And the reason I do that, because when I listen to somebody and I go through my diagnosing, I'm very, what does that word mean? And you say partner, it takes me down a partnership path. You say shareholder, it takes me down a shareholder path. So when I'm diagnosing something, I'm very precise in the words that I'm using, or try to be, which clearly you've seen that I'm not at times. And I try to be very precise in listening to the words that are coming at me. Because the words help me diagnose or choose the path on how to diagnose what's in front of me. So it's shareholder, because we're in a corp. Okay? But you're absolutely right. A K, Schedule K, is 100% of the activity. The K1 is somebody's proportional share. So if we have one shareholder, they're exactly the same. If we have two shareholders, well, this is still 100% and this is 50% because you got two shareholders. Now, the point that I'm making is the items that adjust AAA up and down are the exact same items that adjust basis up and down. So the trap that you can fall into, and people fall into it all the time, which I find funny, is that AAA and basis are the same. They're not. They're not even close to the same. Because Trent, what is AAA?
Undistributed S corp earnings.
Undistributed S corp earnings. And undistributed S corp earnings is measured at the entity level. AAA is an entity level concept. And that entity level concept is our guidepost to tell us how we're going to interact with C1. And C1 was what, Tatum? 1368 C1?
AAA.
Just read it.
Oh. Portion of the distribution which doesn't exceed the AAA shall be treated in the manner provided by B.
Point you back to B. So this entity level AAA is a guidepost to say how much of our distribution is allowed to be treated under ordinary distribution rules. It's a guidepost. It's an entity level measurement. But the ingredients, the items that adjust AAA up and down are the same items that adjust basis up and down. And that is there's such parity between those two that it's hard to separate them as two different concepts. So this question I'm asking, when are AAA and basis different? Because if I started an S corp and it was always an S corp, AAA and based on my formula, K1 item up and down, K1 item up and down, an original shareholder of an original S corporation, AAA and basis should be the same. Because the ingredients that adjust them up and down are exactly the same, and your starting point is exactly the same. So when is AAA and basis different? Do what?
Loans.
Nope.
If you convert to
When you convert to a C corp, that's completely appropriate. I don't mind that. So let me ask this question: if Lucas has a corporation and he's the guy that started it, and his basis is 10,000, his basis is 10K, and AAA, since he started it, what should it be?
10.
10. I buy Lucas's stock for 100. 100, Lucas has 10, 90 gain. What is my basis in my shares?
100.
100. So if somebody buys into the corporation, basis and AAA are now different. What happens if somebody dies? It's going to go through an estate and it's going to get a step up to fair value. Basis and AAA are now different. So there's other ones, but those are going to be the primary ones because, again, we're trying to get through all this, right, Sam?
Yeah.
Okay. So the thing that you need to take away from this is a couple things, right? And I've tried to hammer on. AAA is an entity level measurement. And AAA is what?
Undistributed S corp earnings.
Undistributed S corp earnings. Basis is a shareholder level measurement. They can be the same, but they might not be because somebody bought shares, somebody died. The possibility that they're different exists.
So basically, the answer is change in ownership.
Change in ownership, yeah.
You have the non-deductibles that disappear. Wouldn't that impact it?
Could.